This last decade saw financial markets that were stable and attractive to businesses and investors. The cost of borrowing money was very low, and both earnings and the value of the SP 500 had climbed dramatically. However, the recession caused by the pandemic in 2020 had an adverse effect on financial markets. The typical investor would know to get out of the market during a downturn like this. Successful investors, however, like Warren Buffett, saw this as a chance to turn this into your advantage. And that is what we will be talking about for today. This is Investing Path, and make sure to watch till the end to find out a number of useful things about how to invest in today's market, including things like dollar cost averaging, the types of firms you should look for. But before that, please don't hesitate to give this video a like and subscribe to keep up with our future uploads as we move forward. Now, let's get started. The world's central banks tapped in to combat the pandemic by printing and distributing trillions of dollars to businesses and consumers. This method is now being tested by inflation. The Federal Reserve has had to increase interest rates to relieve pressure on the economy and the financial markets, but this has made it more expensive for consumers and businesses to borrow money. This has had a depressing influence on several markets, including cryptocurrency, real estate, and equities. Nonetheless, you should never forget that investing is a psychological process, and that it is simple to let emotions like fear and uncertainty influence your choices. Many investors make the opposite mistake of buying at market price and selling at a profit. Do not let your emotions cloud your judgment when circumstances are rough. Make rational investment selections. Never forget that investors who are ready to go against the grain might profit from the market downturns. When the market is down, investors can get in at a lower entry point, which can lead to higher returns over time, as stated by experts such as Warren Buffett and Charlie Munger. Investors who have well-defined objectives and a long-term time perspective are less likely to be derailed by the inevitable ups and downs of the market. Most people feel better when stocks are rising, but now is actually a great time to invest because prices are so cheap. The goal is to stick to your long-term investment plan and to not be hesitant to take advantage of opportunities that present themselves when the market declines. There have been 15 economic downturns and 11 market downturns lasting a combined 14 years since 1926. It has been 7 years. Although bear markets may appear catastrophic, they're actually quite rare and give excellent opportunities for contrarian investors. After the Great Depression, returns are 265% in 4.4 years, and after the second bear market, they were 43% in 1.8 years as shown by the chart. Now, among other things, there is a possibility of profit from investing during bad markets. You could have earned roughly 9% on your investment if you bought at the market's peak just before the 2020 sharp dip. On the other hand, if you opted to invest at the market bottom a few weeks later, you would be up roughly 60%. This shows how the timing of your investment's entry can have a major effect on your profits. There have been 75.4 years of bull runs and only 14.7 years of bear markets, so keep that in mind. This means that opportunities to suffer temporarily in order to acquire more money in the long run are extremely uncommon. Investors can find bargains during downturns, but they need a plan to avoid making costly mistakes. Maintain an awareness of market conditions and act in accordance with your investment plan. There are two basic strategies for long-term investment: dollar cost averaging and Warren Buffett-style value investing, both of which can be implemented passively or actively. There are benefits and drawbacks to both strategies, and different types of investors may choose one over the other. It is crucial to stick to a long-term investment strategy and not let short-term market swings influence your choices. High inflation and rising interest rates are two economic factors that can have a significant impact on firms, so it is important for an active investor to keep tabs on these trends. There are a lot of businesses that are just trying to survive. Selecting businesses that can withstand turbulence and provide for their employees through dollar cost averaging in depth is essential if you want to thrive in the current economic climate. Dollar cost averaging is one method that can help you accomplish your goal. You can diversify your exposure to the market's ups and downs by putting away a certain amount of money into an index fund or other investment vehicle on a regular basis. The purpose of dollar cost averaging is to make investing more objective, so that you may take advantage of the market's long-term success, which is normally around 10% yearly. Investing in the S&P 500 when it is on sale is a form of market timing, but it does not need you to pick particular stocks or read annual reports. When the stock market drops, you have the opportunity to buy additional shares at a reduced price. When the prices are lower, it only makes sense to buy more. For those who choose to sit on the outside of the market, dollar cost averaging can help them profit from downturns without making any major adjustments to their investment strategy. However, there are many who, taking a page out of Warren Buffett's playbook, opt for greater portfolio control by buying shares in publicly traded firms at deep discounts on the assumption that the companies in question would continue to perform well. It is important to pick a company that has a pricing power or the capacity to raise prices without a noticeable drop in sales if you want it to thrive during an inflationary period. Coke, for one, may raise prices without suffering a drastic drop in business because of the advantages it enjoys over its rivals. Coca-Cola drink sales increased by 8% in the second quarter, and its concentrate sales increased by 4%, despite the high cost of production. To flourish in an inflationary environment, a company must be able to pass on increased costs to customers without suffering losses. The degree of debt that the corporation has is another important consideration in a rising interest rate environment. A company should have as few debts as possible. While Meta, formerly Facebook, has no debt at all, Google has more cash on hand than debt and a very low debt-to-equity ratio of 0.05. In uncertain economic times, a company's whole business model stability is just as crucial as its debt levels. Grocery stores, for instance, typically do well during economic downturns, as people need to buy food even in tough times. Because of this, consumers may still have to pay for items like food, shelter, and transportation, but they may have less money left over for extras like going on vacation. Companies' business models, pricing power, debt levels, and other characteristics are all essential considerations for active investors. Investment prospects may also be favorable at this time. Overall, the global recession was because of the pandemic. Negative effects on the financial markets prompted central banks to print and distribute billions in emergency funds. However, this has caused inflation at the Federal Reserve, leading to increased interest rates that have made it more difficult for firms and individuals to obtain credit and strained financial markets. Long-term investors can benefit from market corrections by 10% if they enter with a clear strategy, such as dollar cost averaging or investing in companies with solid fundamentals. Do you have the guts to swim upstream and take advantage of the downturn? Leave your thoughts in the section below. This is Investing Path, and if you found this video quite helpful, then please give it a thumbs up and subscribe to our channel and hit the bell button to stay updated for more of our personal financing and investment content. Thanks again, and we'll see you in our next video.